Hey, welcome to Satisfy YouTube channel. In my channel, we're going to talk about personal finance, money, and everything in between. Today, we're going to talk about why you shouldn't buy a long-term insurance savings plan. So the technical name for a long-term savings plan is a regular premium endowment policy. And such policies are characterized by you paying a regular premium, usually monthly or annually, for a very long number of years, maybe 10 to 25 years. And at the end of it, you get a maturity payout. Such plans go by many names. They can be called retirement plans, education plans, savings plans ranging anywhere between 10 to even 25 years. They usually show two columns projecting two different projections, 4% and 3.25%. So such plans involve you paying your monthly premium, and the insurer actually takes your premiums and invests it in their participating fund, which is usually a very conservative portfolio involving 30% equities and 70% in fixed income and other low-risk assets. Now, such plans are quite aggressively marketed even to young people like students and NSFs, and I feel like they are not the most suitable thing that a young person should buy. In fact, even older working adults will find enough reason to stay away from such plans, and here are the reasons why you should stay away from long-term savings plans. Number one, the commissions on such plans are obscene. Now, take a guess. If your friend or agent actually approaches you and tries to sell you a 25-year savings plan, how much commission do you think he or she earns? Say you set aside $2,000 a year on such a policy. How much of your first year commission actually goes to your agent? Is it 20%? 40%? Surely it can't be higher than 60%. Now, if you guess anything less than 100%, you're actually wrong, because your whole first year premium actually goes to the agent and the agent's manager, and in some cases, the agent's manager as commissions. So none of your first year premium is actually saved. 100% of them has been paid out as commissions to the agent and his upline managers. Now, someone called Hayley actually tried to correct me when I said that 100% of your first year premium goes towards commissions. I think you need to fact check some of your information. There is no 100% commissions, and premiums paid doesn't go to the agents. They're paid by the company via distribution costs. Subtle but big difference, IMO. Also, I think you have zero idea how all these things work because you're not in the industry. It's like giving medical advice without a medical license. Shrug. Misinformation like this is detrimental to gullible readers. So Hayley, what exactly is distribution cost? Let's look at the policy contract to find out more. The total distribution cost of this product is the amount that you will pay for advice and for other distribution related expenses. It includes cash payments in the form of commissions and benefits paid to the financial advisory firm and its representatives who have provided you with financial advice. Sounds awfully like commissions to me. In fact, guess who has been in the insurance industry since 2009? I know for a fact that agents can receive 50% of the first year premium as commission and an additional 25% as bonuses if they hit certain sales targets, and of course not to mention the manager's overriding and all the incentive trips that they can qualify for. So what is distribution cost if not for commissions paid to the agent as well as the manager? So tell me, is saying that 100% of the premiums go towards commission detrimental towards gullible readers, or is it detrimental to your business of selling subpar policies to your clients? Now, if you think that's all, 50% of your second year premium is also paid as such. And then in the third year, sometimes as high as 25% is also taken out. Now in total, as much as 2 years of your annual premiums are taken as commissions. So you can only imagine how much money you are not saving when you purchase such a policy. Worse still, such commissions are paid in the early years of the policy. So that leads to a greater time value of money lost, which affects your returns as a result. So if you buy a savings plan, I hope you like your agent a lot because he or she is going to like you a lot better, at least until they have to make a new sale. The number two reason why you should avoid such policies is that such policies tend to be invested in overly conservative portfolios. The portfolio tends to be invested in about 10 to 30% equities and the rest in fixed income and property and other low-risk assets. You might be wondering, hey Seth, what's wrong with a low-risk portfolio? I don't want to take risk or I don't want to lose money. Low risk is good. Now, the reason why this is bad is because it is simply too conservative for a long time horizon like 20 to 25 years. Historically, equities have done very well, especially over a long-term period like 20, 30 years. So if you invest too conservatively, you may find a lot of opportunity costs in 20 to 30 years' time. You're already locking up your money for 20 to 25 years, so you might as well put them in equities, which is more volatile in the short term, but gives you much greater return in the longer term. Now, the rule of 100 states that you should take your age and subtract it from the number 100. So if you're 30 this year, you should take 100 minus 30, and the remaining amount is what you should have in equities. So as a 30-year-old, you should at least have 70% of your investment portfolio in equities. with 30% in more conservative classes like fixed income. As you grow older and reach 50, then you will have 50% equities and 50% fixed income. So as a 30-year-old, buying something that gives you only about 30% equity exposure is simply too conservative, especially for a 25-year time horizon. Now, some people even feel that the number should be 120, which means that as a 30-year-old, you should have 90% in equities and not just 30% or even 10%. Now, even if you're risk averse, you should consider rule of 80 instead and put at least about 30 to 50% of your investment into equities. Again, if you're considering even buying a 25-year savings policy, you're actually saving for the long term, so you should not be so afraid of short-term volatility in the equity market. Now, the third reason is that even if you really like the low-risk nature of the product, the risk-adjusted return of the product is simply too lousy to consider. Now, let's say you're really risk-averse and you think that you want less than 30% equity exposure, you can always buy investment portfolios that reflect that level of risk that you're comfortable to take. So if you were to get an investment portfolio that only has 30% equity exposure and 70% in safer instruments like fixed income, chances are you still perform much better than a savings policy because you did not have to give up 2 years of upfront premium to your agent as commissions. It is true that savings plans are of lower risk, but you can also find investment portfolios that give you similar risk levels but much better returns because of lower fees. Now, the fourth reason is that such plans actually offer you very poor liquidity. If you need to withdraw money, usually they don't allow it, or they have you borrow against your savings and charge you interest for it. Now, this is in contrast to other investments that actually allow you to liquidate your holdings at market value. For example, if I were to buy stocks or ETFs or invest in robo-advisor, I can always liquidate my holdings for money without having to incur a penalty. Why should you be charged an interest for using your own funds? Now, in fact, if your financial situation gets worse and you have no ability to pay the premium for your savings plan, the savings plan will actually lapse and give you less than the capital you have put in. For most other investment, you can actually pause your contributions towards investing if your financial situation is bad, and then resume when your financial position gets better. Number 5, insurance companies can and have cut bonuses before. Now, if you bought a savings plan expecting low volatility, you'll be mostly right until the insurance company actually experiences year-on-year of bad returns. That's when the insurance company can actually say, okay, returns have been quite bad, we are going to cut bonuses. And that's when your projected values actually go down as a result of poor investment performance of the insurance company's participating fund. Now, lastly, purchasing such plans don't give you the assurance that you get continuing service from an advisor because the commissions have been paid upfront in the first few years. Now, it does not matter how well or poorly the savings plan does, your advisor actually has no financial incentive to continue providing you with a service because the commissions have been paid in the first few years. In fact, it is unsustainable for him to provide continuing service to someone that no longer gives him a commission. The nature of upfront commissions is such that he's always chasing the next sale. He has no financial incentive to service you, especially if your plan has been bought years and years ago and his commission has been long collected and spent. Now, contrast this to other investments like using a robo-advisor. If you feel that the robo-advisor isn't giving you as good a service, you can always switch out your holdings for another robo-advisor or find another investing platform that you think will provide you with better service. So what are some alternatives that you can consider rather than buying a savings plan? Now, we live in the age where fintech is booming and there are new solutions that are coming out every other month. There are so many robo-advisors to pick from these days, and there's never an easier time in history where investments are so accessible and cheap. And don't be afraid of the word investment. Make no mistake, a savings plan is also an investment, but something that's arguably too low risk for a long time horizon and something that's just laden with too much upfront commissions to be an attractive product for you to consider. So you should consider better forms of investment rather than seeing savings plan as something that's very safe and not investing when it actually is an investment product. Consider taking higher risk if you have a longer time horizon. And if you're buying a 25-year savings policy, you definitely have a long time horizon. Also, if you are really very risk averse, you can still invest in a risk averse manner. There are conservative investment portfolios that are about the same risk level as a savings plan, yet offer you better returns and better flexibility. So I've placed some recommendations in the description below, and of course, a full disclaimer, I get some referral incentives when you sign up for them, but nothing compared to the commission you would pay if you were to sign up for a savings policy. But hey, I'm going for the numbers game. If 50 people sign up, I think I'll earn more than Hayley selling one endowment policy to her client. If you like this sort of content, please give me a like and also consider subscribing. If you can, please leave me a comment so that this video gets picked up by the YouTube algorithm and more people will see it and hopefully can avoid savings policies. So do a good deed today, comment. So until next time, please stay away from savings plans and I'll see you next video. I think you need to fact check some of your information. There's no 100% premium. Premiums paid doesn't go to the agent. They're paid by the... Oh, Hayley.